Dear BTech students, in the fifth unit, capital and capital budgeting, the next topic we are going to discuss is working capital. In this working capital, after this lecture, you are going to learn about the definition of working capital formula, need for working capital, and factors affecting working capital requirement. Next, the definition of working capital. Here, the definition of working capital means simply we can say that working capital is money that is available to a company to meet its day-to-day operations. So, this working capital can be calculated by the difference between current assets and current liabilities of a company. Now let me say what is current assets and current liabilities. Current assets include money at hand, money in bank, raw materials, finished goods in inventory, accounts receivable, temporary investments, etc. Then current liabilities. This current liabilities includes all the expenses and debts that will repay within the year. Some of the examples of current liabilities are accounts payable, dividend and income taxes, etc. Next, let me tell what is the formula of working capital. Working capital formula is working capital equals to current assets minus current liabilities. That means working capital is what's left over when current liabilities are subtracted from current assets. Next, the need for working capital. So here we are going to discuss why actually this working capital is required for the company. The working capital is needed mainly for following purposes. That is, for the purchase of raw materials, to pay the wages, salaries and other day-to-day requirements, that means day-to-day expenses of the company. Next is overhead expenses. Overhead expenses such as fuel, power and other office expenses. Then to meet selling expenses such as packing, advertisement, etc. Then to provide credit facilities to the customers. Then to maintain the inventories of raw materials, work in progress, stores and spares and finished stock, etc. For these purposes, the working capital is required for the company. Next, what are the factors affecting working capital requirements? Now we are going to discuss what are the factors that affecting the working capital requirements. There are nearly 7 factors, main factors that affect the working capital requirements. So they are, first one, nature of the business. Second one, size of business. Then production cycle. Fourth one, technology. Fifth one, business cycle fluctuations. Then next one, profit changes. Other one, the last one is seasonal variations. In this way, these factors affecting working capital requirements. Now let me explain one by one factor. That is, the first one is nature of the business. The working capital requirements of a firm depends upon the nature of the business. For example, public utility undertakings like electricity, water supply and railways need very limited working capital as they provide services only. Next, on the other hand, trading firms require more investment and it needs more inventory. So, that is about nature of business. Next about size of business. The working capital requirements of a company influenced by the size of the business. If the size of the business unit is greater, then the requirement for working capital is also larger. Then the next is production cycle. What is production cycle? Production cycle means the time taken in the manufacturing process of goods. That means the period between the procurement of raw materials and the production of the finished product. That is known as production cycle. In case of longer span of production cycle, higher working capital will be required. For example, the cotton mill will require more working capital than the bakery. Next factor is technology. The use of modern technology, the use of modern machines and equipments makes the production process very faster. Conversion of raw materials into finished goods become quicker, labor cost is also reduced. So, the working capital requirements is also become lesser. So, that is technology. Then, business cycle fluctuations. In the situations such as recessions, depression and recovery in the economy like today's situation, the demand for goods increases. So, production expansion is required. So, large amount of working capital is required to meet the demand. Then, the next factor is profit changes. If the organization generates more profits means then there is an opportunity for the companies to allocate more profits for the working capital. Then the last factor which affects the working capital is seasonal variations. In this, if the raw material availability is seasonal like mango, they have to be bought in bulk during the season for uninterrupted production. So, a huge amount is blocked in the form of materials and inventory during that season, which requires more working capital in that season. So, in this way, different factors that affects the working capital requirements. Yes, dear students, now I am going to explain the next topic in the 5th unit, capital and capital budgeting. The topic I am going to explain is capital budgeting, very important topic. In this topic, we are going to discuss about the contents like definition of capital budgeting, process of capital budgeting, then capital budgeting techniques. Now let me explain what is the definition of capital budgeting. You know very well, I think you already heard the word what is budgeting. Whenever your father earned the income, in that income he allocates the money to different purposes. For different purposes like bringing the grocery items, then paying some of the amount to the fee, paying some of the amount to the rent. Likewise, among whatever the amount he is having, he budgets some amount to different purposes. In the same way, in company also, the total capital should be invested on different projects to get the profits in the future. That is known as capital budgeting. Now let me tell what is the definition of capital budgeting. Here, capital budgeting is the process of making investment decisions in long-term assets or course of action. That means capital amount which is incurring today with the expectation of bringing the benefits over a period of time. So, this capital budgeting is the process of deciding whether to invest in a particular project or not. The manager has to choose a project which gives more benefits with less cost. Then let me explain about what is the process of capital budgeting. In this process of capital budgeting, there are 4 steps. That is, first step, project generation. The second step is project evaluation. The third step is project selection, and the fourth step is project execution. In this way, there are 4 steps in capital budgeting process. Now let me explain these 4 steps. The first step is project generation. So project generation means here, in the project generation, the company has to identify the project proposals to be undertaken. Then the second step is project evaluation. So here in this project evaluation, evaluating the benefits and the cost of project proposals. Then the third step is project selection. The final selection of the project may generally done by top management of the company. The project which gives more benefits with less cost will be chosen. That is project selection. Then the fourth step in this capital budgeting process is project execution. In the project execution, the top management or the project execution committee is responsible for effective utilization of funds allocated for the projects. It must see that the funds are spent as per the capital budgeting plan. So here the next in this capital budgeting is capital budgeting techniques. This capital budgeting techniques are classified into 2 types, that is traditional methods, discounted cash inflow methods. Traditional methods includes 2 types, that is payback period, then average rate of return. Then the other one, discounted cash inflow method, that is includes internal rate of return, and the next one is net present value. Now let me explain traditional methods. In the traditional methods, the first method is payback period. Payback period means the number of years required to recover the original investment. That means whatever the investment we incurred, after how many years we are going to getting back that investment. So that is known as payback period. The payback period formula is here, payback period equals to original cost of the project by annual cash inflow. A project with the shortest payback period is treated as the best project. Next, after that, let me tell some of the advantages and disadvantages of payback period. Some of the advantages are, first one, simplicity. That means this payback period method is very simple and very easy to understand. Then the second one, reducing chances of loss. Here we prefer the projects with short payback period. So this we can reduce the loss. Next, after that, the third one is quick returns. Quick returns means we can pick up projects with quick return based on the recommendations of payback period. Next, after that, some of the disadvantages of payback period is avoiding cash inflows. That means this method fails to take into account the cash inflows received by the company after the payback period. Next, overemphasis on liquidity. Here, the company prefers those projects which have shorter payback period and quick returns, but it is ignoring the excellent projects with longer span and higher returns. So these are some of the disadvantages of traditional method, that is payback period. Then the next method in traditional methods is average rate of return. Average rate of return means the ratio of annual profits after taxes to the average investment. It is known as average rate of return. So here average investment means it is equal to half of the original investment. The formula for average rate of return is ARR equals to average annual profits after taxes by average investment or original investment. Next, discounted cash inflow methods. Normally, this discounted cash inflow methods takes into consideration the time value of money. Time value of money means interest earned on the money. For example, if you give 1000 rupees at an interest of 10% to your friend, at the end of the year, you will get 1100 rupees. The 100 rupees interest you earned on that 1000 rupees is known as time value of money. So under this discounted cash inflow methods, there are two methods, that is net present value and IRR. Net present value. Net present value is the difference between the present value of cash inflows of a project and the initial cost of the project. That means the formula of net present value is NPV equals to present value of cash inflows minus investment. Investment means cash outflow. So NPV equals to present value of cash inflows minus cash outflows. Next, the next method is IRR, that is internal rate of return. So it is the rate of return at which the net present value of a project becomes zero. That means, in the other words, it is the discounting rate at which the net present value NPV is equals to zero. The formula for IRR is IRR equals to cash flows by 1 plus R whole power I minus initial investment, where cash flow equals to cash flows in the time period, R equals to discount rate and I equals to time period.